Hi, Johnny McNamara here again from MCN Associates. In today's seminar I'm going to take you through a simple guide to pensions. So what exactly is a pension? A pension is essentially money that you will live on once you retire. It's created by putting money on a monthly basis into a pension plan throughout your working life. Its goal is to provide yourself with sufficient funds to live comfortably once you retire. So like I said, a pension is built up throughout your working life by putting monthly contributions into a pension plan. So what exactly is a pension plan? A pension plan is essentially a long-term savings plan with tax breaks. The contributions are invested on a monthly basis into funds, usually through a life company. The funds grow tax-free within the funds in the life company and are accessible then on retirement. There are a number of types of pensions available, and it's important just to outline what these are. I won't go into too much details, but just to give you a brief synopsis on the different types of pension plans. The first type is a personal pension. This is essentially available for people who aren't part of an occupational or company pension scheme. The second type is a personal retirement savings account, or PRSA as it's commonly known. This again is designed for someone who wouldn't be part of a company pension plan, and it's designed to be available for almost everybody. The third type is an occupational pension scheme. This is typically done through your employer, where they might contribute to a pension scheme and also you make contributions. The fourth part is an additional voluntary contribution. This is aside from normal occupational pension schemes and allows you to make additional contributions into your pension. The last one there is the executive pension schemes. These are usually one-man arrangements whereby people set up these plans, they remain trustees and they look after their own pension. So why is a pension plan needed? Well, there's a number of reasons why a pension plan is needed. The most simple being that once you reach a certain age, your ability to earn money will diminish, but the bills will still need to be paid. You'll also want to enjoy your life once you stop working. If you look at the stats, 20 years is not an exceptional period of time to live after you retire. So it's a long time. You'll need funds. The bills will still need to be paid, and like I said, your ability to earn will go down. So it's a reward for working hard all through your working life and putting money aside. So you owe it to yourself to put money aside for your future. And one of the questions that really hits home is, and you should ask yourself, do you want to be a retiree or a pensioner? And what I mean by that is, if you picture in your head what a pensioner looks like, typically you'll picture an old lady scrambling through a purse for maybe a couple of coppers to pay at a till or a supermarket. Whereas if you picture a retiree, what comes to mind is maybe someone on a golf course who has plenty of spare time and spare cash to do what they want. So, a pension is designed to provide you with the retirement of a retiree as opposed to a pensioner. So who needs a pension? Well, if you look back at the last slides, essentially you need a pension, or everybody needs a pension. If you look at what the current state pension is, it's €230 per week. It's not a huge amount, and you must ask yourself, is that, once you retire, would that be enough for you to live? Like I said, your ability to earn other money outside of this diminishes, so you could find yourself very quickly on just €230 a week, and the bills still need to be paid. So a pension, why you need it or who needs it? Well, everybody needs it to avoid the situation whereby you're really struggling in your old age to pay the bills. So what exactly are the tax breaks? Like I said, a pension plan is essentially a savings plan, a long-term savings plan with tax breaks. So when you pay into your pension plan, essentially what happens is the taxman pays back part of the contributions that you make. How much they'll give back will depend on the tax band that you fall under. So in the example given below, I've used a contribution of €1,000 to a pension plan. So if you pay tax at the lower rate of 20%, the net cost to you is €800. So what happens is the taxman gives you back €200 in that case. So you've been able to invest €1,000 for a cost of €800. If you're at the higher rate of tax, the 41%, the net cost to you of putting that €1,000 away is €590. So essentially, in this case, the taxman gives you back €410, and you've been able to invest €1,000 for a cost of €590. So if we look at the contributions to your pension plan, and who makes these contributions? Well, essentially, it's going to be you that makes the contributions. If you're lucky enough, maybe your employer will make contributions into an employer pension scheme, but essentially it's up to you to contribute to your pension, because it'll be you that benefits in the long term. How much should you contribute? Well, really, that's up to you. Like I said, the goal is to be able to enjoy your retirement and be able to do the things that you want to once you retire, like holidays and various different things. So how much you contribute is really up to you. Obviously, there is revenue limits, but the important thing is that you set your own goals for retirement, outline a vision for what you want to be in retirement. Like I said, do you want to be a pensioner or a retiree? And then you should aim to achieve those goals through your monthly contributions. When should you start? Well, it's never too late to start, because it's important that you put money aside for your pension, no matter how late in life that is. So really the answer to when should you start is the sooner the better. So once the contributions go into a pension scheme, where do they go? Well, like I said, they're invested in typically investment funds within a life company. The mix of these funds is really up to you. It depends on your risk profile. So what typically happens is that you'll decide on a mix of different investment funds within your pension that suits your attitude to risk. So quite often people would take a high risk attitude to their pension fund, and they'd create a mix of funds that would suit that high risk strategy. Other people would take a much more lower risk with regard to their pension funds, and they'd go into funds within the pension fund that are low risk, and so there'd be low volatility in them. Within the pension, you can select from a wide range of funds, and typically there'll be someone there to advise you on the range of funds, and like I said, put in the correct mix of funds that suit your attitude to risk. So one of the most important things to do is to understand exactly where your money is invested. So if you're a low risk investor, it's important that you find out or make sure that your money is invested in low risk funds. So know the risk profile of how you're invested within your pension, and one of the key points is to take control of your pension and get advice, because it's money that you're putting in, contributing to, and it's for your retirement. So you really should get to know exactly where your money has been invested and how it's growing. One of the questions that's very pertinent at the moment is changing jobs and what happens to the pension once you change jobs. So there's a number of options with regard to, if you've been an employer pension scheme, what you can do with the money built up in your pension. And there's three real options that you have. There may be more, but just the three basic options are leave the fund in the existing pension scheme. So it essentially sits in the scheme where you had been contributing to, and it will be available then under normal circumstances at retirement age as per the scheme rules. The second option is that you can bring it with you to a new employment. The new employment has to have a pension scheme available within it, so you're transferring from one pension scheme to the new pension scheme. So there must be a pension scheme there willing and able to accept the transfer. The third option is to transfer the benefits that you've built up in the pension to a personal retirement bond, and essentially what that is it takes the benefits that you've built up in your occupational pension scheme and puts it into a bond in your name, and the same rules apply. It's accessible at normal retirement age. So once you've built up your pension fund and you've contributed throughout your life, what happens at retirement? Well, what happens is there's a part of the fund that will be available to you tax-free. The amount of tax-free cash is subject to rules, but a portion of the entire pot will be available tax-free. The balance then, after you've taken the tax-free cash, will be used to provide a pension for you. And there's a number of different ways that this pension can be provided, and it's important that you get advice in the option that suits you. So the two options essentially for the balance of the funds are, firstly, you can purchase an annuity, and I'll go through what exactly an annuity is in the next slide. Or the second option is to put the money into an approved retirement fund, and again I'll go through that in the coming slides. So what exactly is an annuity? Well, an annuity is basically a guaranteed income for as long as you live in retirement. So if you retire at age 65 and you purchase an annuity, essentially what it'll do is pay you a set amount of income for as long as you live. There are a wide range of different options with regard to annuity that affect the cost of buying the annuity, and just some examples are possibly a guaranteed period where no matter if you live for only 1 year after retire, that maybe the pension pays out for a guaranteed maybe 5 or 10 years even after you die. Or possibly you can add a spouse's pension, so after you pass away, that pension will be paid to your spouse, and the effects of adding these extras will result in possibly a lower income being received, but they are benefits, so you're paying for those extra benefits. The second option, like I said, is to invest in an approved retirement fund, or an ARF as they're commonly known. And basically what this is an ongoing investment that you control post-retirement or after you retire. Now, there are certain criteria that have to be met to allow you to be able to access an ARF or approved retirement fund, which I won't go into now, but your advisor will be able to tell you of these. So essentially what happens with an ARF, like I said, it's an ongoing investment and is subject to market conditions, and you have to invest that to suit your own risk profile within an ARF. And essentially what happens is you draw money from the ARF subject to income tax as you want. Now the minimum withdrawal is 5% per annum that you must draw every year. So that's revenue have dictated that you must draw 5% every year from your ARF. But essentially you can draw more if you need it from your ARF. And obviously that does have risks because you can deplete your fund. If you're drawing, say, 20% per annum, well, you can work out very quickly that your fund would only last maybe 5 years, assuming no growth. So it needs to be carefully managed. One of the great advantages that the fund, if you pass away and there's still an amount in the ARF, it can be passed on to your estate, and so you're keeping the value of the money in the pension fund and passing it on to your family once you pass away. But there are no guarantees. It's subject to investment choice, and so you could take a high risk investment strategy with your ARF and find that it depletes in value quite rapidly, or otherwise you could actually take a high risk and it could perform and actually create increased value and increased wealth as well. But it has to be managed carefully and really needs advice to be taken. So the conclusions of just this simple seminar, I mean, the need for pension funding has never been greater. People will question whether the state can continue to fund for the old age pension. So we really have to take control and start contributing to a pension as soon as possible. The other thing to do is to get to know your pension. Too often we find that people are contributing to a pension but really don't know what entitlement that gives them at retirement, what value that gives them at retirement, or even what they're investing in throughout their working life. So it's important to get to know your pension intimately, if you like, because it's your money that you're putting aside and will provide you with your retirement. You need to set your retirement goals, and that will dictate how much you need to contribute on a monthly basis. So like I said, if you want to have an enjoyable retirement where you can go off and you play golf and you can holiday, you need to contribute sufficient funds to allow you to do that. It's important to review the pension regularly, and this is part of taking control of your pension, to look at it, how it's performing, changes in pension legislation, changes in market conditions, which will all have an effect on your pension plan. And so review it regularly. I'd suggest maybe once a year with your advisor. And that leads on to the next thing, is to get advice. Pensions is a complex environment, and you need to get advice from an expert to allow you to take control that you need. So that's the end of the seminar. I hope you found it of use. If you want to talk to me, I'm available by email or phone. The information is given there on the screen, and I hope to speak to you soon.